Tell me if this sounds familiar. You've learned the basics of options trading, you've picked out a strategy you like, you go to place the trade, and you start sweating like an 8th grader at their first school dance. I get it. You're nervous about making a mistake. What you need is a checklist to help you feel confident you aren't forgetting anything. Well, sharpen your pencils. A seasoned options trader is about to share his top do's and don'ts to help you out. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Rob Moise. Options Education Month continues at TD Direct Investing. We've dedicated all of June to helping you improve your options trading. And there's still a ton of great content on tap, so check it all out at td.com/OEM for more details. We're really excited to bring you today's episode. A seasoned options trader is going to share his top tips for options trading and break down one of his favorite strategies that he's using to help bolster his portfolio during these uncertain markets. Plus, we're going to take your questions about options trading strategies and best practices later in the show, so make sure you stick around to the end there. We've got a lot to get to. Let's get down to it here. Joining us is David Jaffee, founder of Best Stock Strategy. He's an Ivy League grad. He's a former investment banker. He's got over 10 years of experience trading options, and now he offers coaching and trading signals to his community. David, wonderful to have you with us. Appreciate you taking the time to chat.
It's great to be here.
David, I got to say, very accomplished here you are, sir. Ivy League grad, you worked in investment banking, probably collected a pretty sweet paycheck. What made you want to leave it all behind and start trading options for a living instead?
I think these days there's a lot of ways to make money. And when I was working as a junior banker, as an analyst and associate, it was very difficult. A lot of long hours, a tremendous amount of sacrifice, and also a lot of stress. And as the commissions and the rates that these online brokers were charging kept going down and I was making money via trading and investing, I felt that there were many things that I could do where I didn't have to grind for 80 to 100 hours in order to make a lot of money.
That's a crazy work week to have to deal with all the time. It's all about work-life balance, right? So speaking of that, I'm curious, like, what does a typical day look like for you now that you're an options trader full-time?
Well, I'm also a content creator, but as far as the trading side, I have a small watch list of about 20 companies, maybe somewhere around 15 to 20 companies, because 15 are individual securities and then about 5 of them are indices. And then I check and scan the futures market to get some type of inclination regarding how the market's going to open the next day. Then once the market opens, somewhere around the first 15 to 20 minutes, I typically scan my watch list to see what's up and down significantly more than the overall market. Therefore, I look at the variance of the day to see if there are any opportunities. And then I ask myself if this security is worthwhile making a trade on. And if the answer is yes, then I make a trade, and then I send it to the members, etc. But as far as my own personal trading, I basically look at the market multiple times a day, and then I ascertain whether there are good opportunities or not.
So I think it's safe to say it's less than 80 to 100 hours a week, right?
Oh, yeah, definitely. But also remember, when you're working in investment banking, you're very young. So they get people who are 20, 21. And usually when you're that young, you have more hunger in order to make the necessary sacrifice and to do anything possible to make more money. So just like in investment banking, the 40-year-olds who were working as executives or managing directors, working like 9 to 7 with a lot less stress. So I guess as you get older, you have a tendency to take on less stress.
Well, it's not to say that options trading is without stress by any means, but perhaps more manageable stress in your case here. You are a prolific content creator, I will say. Many years you've been creating all kinds of options-related content here. And one of the interesting things I found about your content is that your strategy has evolved over time and your philosophy towards trading options. You used to be more of a strictly sell options for income kind of guy, and now you've kind of come around to this idea of buying options too. So, like, what changed your mind?
Yeah, it's a great question. I think at its most simple, and the most important point is that the VIX has a tendency to be below 15 for, let's say, 70 or 80% of the time. And during that time, when volatility is low, it's extremely difficult to collect substantial premium, especially when the market is rising, unless you're going to substantially increase your size and trade too large. Yes, I know that you could trade a cash account. However, it's very difficult if you're just going to sell premium when you're using vertical credit spreads and naked options in order to actually beat the market. When you're selling options, you're going to have to collect enough premium in order to beat the market. But the problem is that when you sell options when the VIX is below 15, it has a tendency to become, those strike prices have a tendency to then blow up and show you losses the 2 to 3 times a year when the VIX spikes over 25 or 30, and once every 5 years or so when the VIX spikes over 50, like it did earlier in 2025. So I think that when you're able to buy options, let's say you can get $10 of potential upside, but if you only pay $3 or $4, you can then subsidize or actually finance that $3 to $4 by selling naked options, specifically puts, at a price where you actually want to own it. So I think that type of, it's not necessarily arbitrage because you're selling out of them, because rather you're buying out of the money called debit spreads. But I believe that it's much better than simply selling options, which have a tendency to blow up once VIX increases due to a market pullback.
Yeah, I mean, use all the options available to you, no pun intended here, right? And you talked about debit spreads here. That's a little teaser for what's coming up later in the conversation. But for now, I want to get down to the heart of our conversation, of course, and that is the do's and don'ts that you have for options trading. And for those in our audience, if you want to get in on this conversation, make sure you submit your questions to us. If you're watching on Webroker, you can use the chat box to send your questions to us. If you're watching on our broadcast platform, you can use the questions and comments box. And if you're watching on our YouTube live stream, you can click on the link in the description. It's going to take you over to the broadcast platform, and that's where you'll be able to ask your questions. All right, David, so let's start with some of your big picture do's and don'ts, if you will, regardless of what strategy we're talking about here, just kind of the foundational stuff that can get you going here. And let's start on a positive note here. A do, your first options trading do is to only trade stocks on a short list that you have. Why do you feel that is so important in your experience?
I think it's very important not to speculate and trade penny stocks and things of that nature, because for every Palantir, which previously people were purchasing it at around $8 and now it's trading at around 140, for every one of those, there's a ton of those $8 stocks that end up going to $2 and or potentially even going to zero. And the problem is when you have a tendency to invest in more speculative assets, even on, if let's say half of them don't work out, then you have to compensate for those losses by trying to hit home runs on other securities. Plus, there's also when you focus on the largest cap companies. So let's say the biggest companies in the world, like NVIDIA, Microsoft, Amazon, Meta, et cetera. Those companies, even though they are a little bit more volatile because they're in tech, you also don't have to spend a lot of time educating yourself and trying to find all of the latest and greatest information and the potential mispricings. Because when you have a $3 trillion company like NVIDIA, there's really nothing that your education or that your research is going to indicate that hasn't already been priced into the price of the stock. So I think that by focusing on the largest companies that have the deepest markets, therefore the bid-ask spread differential is relatively small, so there's the least amount of slippage. You also have the time advantage of not having to know the ins and outs of every single company that you invest in. I think that is the best. And plus, because they're the largest companies, they have a tendency to be a little bit less volatile and lower betas than the speculative stocks.
And you had mentioned that you have a watch list, if you will, of like 15 to 20 stocks or so. How many positions would you trade at one time? Both like the number of stocks that you actually have positions against and like the number of positions you hold in total.
Yeah. So I guess you can characterize it by two things. There's the number of individual securities. So I think that is dependent upon how large your account is. If you have, let's say, $10,000, then trading 2 ETFs or 2 large cap companies, or I would say at a maximum, 2 companies and 1 ETF would be fine. But even with a larger account where you're talking about like over 500,000 or over $1 million, I would say ideally somewhere around 5 to maximum of 7. Now, within those individual 5 to 7 securities, you can have different expirations. So you can have different trades that expire on different weeks. You can have potential hedges if that's what you want to do. But I don't think that it's worthwhile to have positions on 20 different securities. And part of the reason is that if the market pulls back, if you have too many positions in your account, then since there tends to be correlation risk, and during that time, it's also very stressful, you don't want to feel overwhelmed. And then additionally, I'm also a big proponent of allocating capital to your best opportunities. So I don't necessarily want to have too many positions because it uses up mental bandwidth. But at the same time, I also want to allocate the most amount of money that I have to the best opportunities, or at least what I perceive to be the best opportunities.
Right. So these are like higher conviction plays that you're pretty confident in, rather than going like totally diversified. Okay, that makes sense. Let's get to one of your don'ts here, and you sort of teased a little bit earlier there, and that's avoiding selling options on like really speculative stocks, particularly ones that are very volatile. You talked that you like tech and stuff like that, and some of the really large caps. What does a good stock candidate look like for you then? If you're avoiding these like more speculative plays, what is the universe of stocks that you'd like to consider?
So some of the companies that I trade?
Not specific companies, but the types of companies. Like, are there certain sectors, or does it have to be a certain market cap or a certain amount of volume, that kind of stuff?
Yeah, I definitely prefer to trade large cap tech, and primarily because I like to buy call debit spreads. There is a substantial amount of movement. And then also when you have a large company like NVIDIA or Meta or Microsoft, because of that movement, you're able to capture a lot of upside on the call debit spreads. Like, for example, a few weeks ago when Microsoft jumped up after earnings, I think it was up around $30, $35 after reported earnings. That's the type of move that you're not necessarily going to get in General Electric or one of the other companies. So I like those large cap companies. I also like some financial stocks. I'll have something like JP Morgan or Blackstone on my watch list, and indices. And basically, I try to keep it relatively concentrated within tech and ETFs, and maybe sprinkle in a few finance stocks.
Okay, let's get to your next do on your list here, and that is to keep your trade sizes relatively small. So I'm wondering if you have like a general rule of thumb on position sizing.
Yeah. In general, I think if you're going to trade naked and you're going to use margin, whether it be regulation T or portfolio margin, you should probably leave, I would say at a max, probably around 35% minimum and around 50% maximum with respect to your buying power or your excess liquidity. And the reason for that is early 2025 was a great example. Around April, when VIX spiked up over 50, if you sold naked options when VIX was trading below 15, then those put options are going to end up showing you a large loss. So the absolute worst thing that you want to do is be placed in a margin call and have to close out those positions. And remember, we only sell put options on stocks that we actually would love to take ownership of. The issue is, and I see this quite often, is that people might be okay with owning a stock at a specific price, but then if the market corrects by 20 or 30%, like it did earlier in 2025, then they might feel a little bit uneasy taking ownership of the stock at their short put strike if it's 15% above the current market price. But remember, the issue is that as long as you have excess buying power, then those are actually the best opportunities, because then you can ride up and take advantage of the capital appreciation. But you can't do that if you get a margin call. So definitely you don't want to trade too big, and at all times trying to have somewhere where between 35 to 50% of cash available to withdraw or excess liquidity. Different brokers call it different things. I think that will provide you with the necessary safety net to make sure that you're safe during a crash.
That's a really savvy sort of range to kind of consider here too. I really like the thought that you put out there about only trading things that you'd actually want to own, because just in case you have to, you got to be comfortable holding it. One of the things we heard last week when we were speaking with Kirk Duplessis from Option Alpha was that he was suggesting beginners should consider something like in the range of 5% of their account with each position that they take. What do you think about that number? Yeah,
I mean, like I alluded to earlier, I think that investors should allocate their the most amount of capital in to their highest conviction plays. And I think Warren Buffett said that if you have 20 good, that you should look at your life as a punch card. And if you have 20 good ideas, then you can become a multimillionaire or you can become super rich. I just don't think that if you allocate 5%, that means that you essentially have 20 good ideas at any one time without even the rotation. So in general, I basically trade the same companies all the time. And I don't think that strategy is bad. But for example, if you're going to trade 5% in SPY, but you already have significant diversification in the actual index. So I disagree. I think that you should allocate more money to your highest conviction plays.
Okay, so a little other side of the coin there for people to consider here. One of your options trading don'ts, and we touched on this a little bit earlier here, is this idea of avoiding selling options when market volatility is really low. And you talked a little bit about how that could come back to burn you, but just in general, like, why does that potentially make things really difficult to be profitable as an options trader?
Yeah, and I mentioned this earlier. However, even though it's really easy to theoretically say that, okay, don't sell options when VIX is below 15 or when it's below 17, the reality is that it has a tendency to be below 15 or 17 around 70 or 80% of the time. So you're going to have to trade options. I think that probably a more prudent way would be to lighten up on your position sizing. And to answer your question directly, the reason why you don't want to sell options or aggressively sell options when volatility is low is due to the volatility increase. You can have a situation like, for example, let's take Tesla, where at one time, so Tesla was trading at around 250, and then there was an election, and then Tesla jumped up to, I think, $488, right? That was maybe in like December 2024. So if let's say you thought that it would be an amazing idea to own Tesla at 380. So you sold the put option at Tesla at 380, which that sounds like a great trade, right? You're able to pick it up for $108 below where it's currently trading at. Now, I'm assuming, obviously, you're not going to sell puts at the high, but around there, let's say $100. But then we had the market pullback and VIX spiked up to over 50 and over 55, I believe, and Tesla dropped down to around 225. So if you sold that 380 at that time, yes, you can roll it a little bit. But that trade where if you picked up, maybe depending upon the expiration, let's say you picked up $4 or $3 when Tesla was trading at 480 and you sold the 380 put, that trade now with VIX spiking over 50 and Tesla at around 225 is probably trading, I don't know, you're just going to get crushed. You're going to have thousands of % losses on that. So I think it's very important to make sure that you watch your side. On the flip side, and I wanted to mention this as an addendum to the last question, trading vertical credit spreads does allow you to increase your size a little bit because it neutralizes that volatility component. So just like I spoke to earlier, where I said that you would have both the the volatility, the VIX component, but you would also have the difference between the current market price and the strike price. If you're trading defined risk, then that eliminates the downside. It's a defined risk, so it eliminates the tail risk rather, and it also neutralizes volatility. So basically, I think the takeaway is when VIX is low, you do want to be careful not to aggressively sell options because we don't know what's going to happen in the future, and you always want to think about scenario.
You said, sometimes you can't avoid, waiting around for implied volatility to be at your ideal number here. So, what do you do in situations where the implied volatility might be a little bit lower than you'd like to see it as an option seller? Do you just not trade in those times? Do you wait, or do you do different types of trades? How do you manage that situation?
Yeah, that's a great question. You would basically do different types of trades. So what I like to do is, let's say, there were a few times last year when VIX, I think, traded below 12. So in that situation, it wouldn't be the worst idea to put on some hedges. And for hedges, I like to buy some SPY puts. Now, I don't want to overhedge because it acts like a drag on my portfolio, but the hedges did help me during the pullback in 2025. The problem is that you can be buying hedges a year in advance. And if you do that, then you basically are going to lose money on that option decay for that year. So I like to buy elongated hedges. But you mentioned something in your question where you said you change up do you change up the type of trades or your structure? And yes, when volatility is decreasing or when volatility is low, the market has a tendency to be going up and to be in a bullish trend during those times. So I really like to rely upon call debit spreads in those situations. And that's one of the huge benefits, because if you're only just an option seller when VIX is below 15, then you're picking up a small amount of credit, right? Because there's low volatility. That means that there's low fear and people are willing to pay you less, when you're selling an option to them. However, when volatility is low, that also means that you can buy an out of the money call debit spread that's, let's say, $10 wide. You can pay $3 to $4. You can then take advantage and capture some of that upside potential, and you can finance it by selling put options at strike prices where you would love to take ownership and own that company.
We're going to dive into that strategy because I can tell it's one of your favorites here for sure. We've teased it a couple times here, so we're going to get to that in a little bit. There's one other option trading do that I wanted to touch on here that you have, yep, and that's to be very selective about the price that you're selling calls and puts at. How do you think that being really selective can reduce the risk that they're taking in their trades?
Yeah. So basically, I think one of the big mistakes that traders make, especially early traders, is that they think that taking action is going to make you money, when the reality is that it's not taking action that makes you a lot of money, it's making good decisions. And the best way that you could possibly mitigate and reduce your risk is at order entry. So as opposed to having fear of missing out and being overly aggressive and thinking that you have to make this trade, I think that it's better to wait for a setup that you like, where maybe NVIDIA drops from 145 to below 130, or Palantir drops from 138 or 140 to below 125 or below 120, and then you make a trade and then you enter it. You don't necessarily have to chase everything, because if you chase everything, then yes, sometimes it'll work if the market continues to go up, but you're better off just saving some powder, especially having some excess liquidity and only entering the best positions, because that's the time that you can control your risk the best.
One of the really clever ideas I thought that you had was that you, for example, if you're selling a put, you would wait until the stock has fallen to a depressed price, maybe it's down 10, 15% from a recent high, and then you sell the strike price that you choose is like even 10% lower than that.
Yeah.
So you're sort of insulating yourself a little bit, and obviously the reverse for calls here. How did you come up with those numbers, I guess, as a rule of thumb?
Well, everything ties together. So by focusing only on the largest cap companies, you're inherently, I believe, you're reducing your risk, because there's not necessarily an information advantage between you and the person who spends 24 hours a day or 10 hours a day researching the company. And in general, because there's better information on those companies, then those companies have a tendency to be under greater scrutiny. And therefore, if the market pulls back, especially with technology companies, there also tends to be a reversion to the mean effect. So if you're able to pick up a company that is trading at 20 or 30% below where it was trading at just a few months ago, then you have multiple options. You can participate in the upside through long stock, or additionally, you can sell more aggressive options on it. So I think that building in that safety net, because when you're trading options, remember that they're leveraged products. So yes, you can make a lot of money, but I have a tendency to think more so for the negative. Like I expect to win almost every trade that I make, or at a minimum, if the call debit spreads don't become in the money, then it's basically a scratch, right? But so that means that I'm always thinking about how can I eliminate and reduce my downside. So then I would think through and go through situations like March 2020 or earlier 2025 or 2008, 2009. And I want to make sure that I'm never in a situation where I have to close out my positions, because the market has a tendency to rebound. So if you're able to pick it up for 30% below where it was trading at recently, then your cost basis is less, and there's a better probability that you'll make money on that position.
Mm-hmm. I just want to kind of add one more thing in the strike price conversation here, and I want to go back to something that Kirk Duplessis told us last week here. He shared his thoughts on what the ideal probability of success is for credit spreads. Let's hear what he had to say.
Somewhere between 50 and 70%, it'd probably be a good starting point. I will often tell people, and I think they should generally avoid the 80, 90, 99, 95% chance of success trades, which in most cases are truly picking up pennies in front of a steamroller. So it will definitely feel like you're winning a lot until you get smashed over the head and you blow up your account or have a huge drawdown, and then it will take years to recover.
So, David, what do you think about what we heard Kirk say there? Talking about that 50 to 70%. Is that something that would work for debit spreads, like how you like to trade them? And what do you think about, probability of success? What are you generally shooting for?
Yeah, I like that. Kirk's video, it's spoken like a true option trader, because you're always wanting your primary goal. Because you have an expectation that you're going to win a large amount of your trades, you want to make sure that you think about eliminating the large losses. Now, the funny thing is, okay, so when we're talking about expectancy or probability, we're more so talking about delta. The crazy thing is, I don't think I've ever looked at the delta when I buy a call debit spread, and I very, very rarely look at the delta. Maybe when I'm looking at hedges, then I'll buy some deltas, maybe around anywhere from like the 2 to 5 delta. But generally, because the delta is already, or rather the option price already factors in the delta, I will buy call debit spreads that are out of the money. I would estimate they're probably going to be at around like the somewhere between the 35 and 50 delta, but I haven't looked at it. But I'm buying call debit spreads where I feel that I'm getting a decent amount of what I believe to be arbitrage, where you're getting like, your $10 of potential upside for around $3 or $4, depending upon VIX levels, et cetera. And I think that there's a decent possibility that the stock will appreciate to that level. So yeah, unfortunately, I haven't looked at the deltas, so I can't provide you with an exact number, but I believe it's somewhere between like the 35 to 50.
Okay, and delta, just for those catching up here, it tracks, it's an option Greek, and it tracks how much the option price moves in relation to how much the underlying stock price moves here. Interesting that you don't look at deltas there. I know a lot of traders swear by them, but we all have our methods here, right?
Well, remember that the delta is priced into everything comes down to price, right? So it's priced into the option price. And the way that I like to put on the trades is I'll buy the call debit spread and I'll finance it by the put. So if I ask myself when I'm selling the puts, do I feel comfortable owning this stock at this price? And and because I like to structure my trades for like a small credit or a very small debit, if it doesn't fit within that small credit or small debit, then I'm simply not going to make the trade.
Mm-hmm. Okay, David, we're going to get to these debit spreads real soon here. I promise the audience here, because we've talked a little about them a lot. But thank you for sharing those options trading do's and don'ts with us. We got a lot more to come, obviously. But just a quick note to our viewers here who might be itching to get started trading options here. TD Direct Investing has a couple of special offers for you here. So the first offer is that new and existing clients are eligible for a 1% cash back when they transfer $10,000 or more into an eligible direct investing account. Just open a new account with the promo code CASHBACK2025 and fund it within 30 days. You can also enroll an existing account using a registration form if you have one. And the second offer is you can get free access to streaming market data on the TD Active Trader platform until the end of 2025. Again, just open an account, complete the onboarding process before November 30th of this year. You can scan the QR code on screen here for more details and for a full list of terms and conditions. Great offers here. Make sure you check them out. Okay, David, let's get into this favorite strategy of yours here, particularly during these uncertain markets that we're dealing with here. You're trading call debit spreads these days, and then you're selling puts against them too to kind of help subsidize the cost. Walk us through how this strategy works.
So in this example, when, let's say, Palantir was trading at around 125, and you felt that it had increased in price and was a little bit overbought, and you decided that when Palantir was trading at around 110, so therefore it would fall around $15, you thought that it would be a good opportunity in order to enter a trade. So when Palantir fell from 125 to around 110, therefore the implied volatility on that specific security increased a little bit because the price of that security has come down. You wanted to sell a naked put option at $88. This would mandate and require you to purchase Palantir at $88. Now, remember, previously it was trading at around 125. But when it fell down to 110, you decided that you would love to own it at $88. Now, because we don't know what future price movements are going to do, and previously it was trading at around 125, you decided to purchase a call debit spread. So I think in the example, we purchased a 126 by 130 call debit spread, and then we financed it. Financed it means that we sold some put options, or you could sell some call options as well. But for this example, we're going to focus on the put options. We finance because when we buy the call debit spread, we actually have to pay money because it's a debit spread as opposed to a credit spread. So we finance the call debit spread. Let's say it cost us $1.50 or $2 maximum. And then we end up selling and financing it and paying for it by selling the 88 put options. Then I think in the example that we have, we ended up closing it out for around $3.50 because I believe we waited until expiration or potentially a few days prior to expiration. And Palantir was not trading over 130. So I wanted to make sure that I locked in my gains, and we closed it out for a gain of about $350.
Why don't we go to Caitlin Cormier, who's our senior client education instructor here at TD Direct Investing, and she's going to help us understand how you can set up debit spreads in TD Active Trader here. Caitlin, do we have you on the line here?
Yes, absolutely. Hey,
Excellent.
Rob, how are you?
Welcome to the show. Thanks for jumping in here a little bit earlier than expected here. We had heard David talking about call debit spreads here. Why don't you give us a peek at how we could set up a call debit spread in TD Active Trader?
Yeah, absolutely. So, like he said, the whole idea around this type of trade, which can also be called a bull call spread, is that you're buying a call option and then you're selling a call option as well to sort of reduce the cost of buying the call. And the one that you're buying, of course, is going to cost more than the one that you're selling. It's going to be closer to the money. So the second, that's why, at the end of the day, we're going to have that debit sort of position. So if we hop in to the Active Trader platform, I can show you, I have an Apple, just for example's sake, I have Apple up on the screen here. And if we wanted to look out, I have us out to July 3rd here, so a couple weeks time. And so what we might look at, of course, the markets are closed, so keep in mind nothing's live updating right now in the US, but we could look at setting up this bull call spread by potentially buying an option somewhere close to the money. So we could say, this is pretty close to the money here. The stock was closed at 196.58. So we could look at choosing this little plus button here to create a spread and choosing this as the option that we buy, and then go a little bit out from that and choose an option to sell. So let's just say this one here. And what we're seeing is we have a difference in strike prices here. We're having a difference in, of course, the cost of the two, but the net of the two premiums is going to be lower than the original premium if you were to just buy the call to begin with. So essentially that second piece is reducing the cost of the overall trade on this particular option. And of course, because we're buying a call, that is a bullish sentiment. So this would be that bullish type of outlook on the particular security.
And Caitlin, I'm curious, are there any tools that the platform has here that can help traders get a sense of their probability of success that they would have when they're placing a trade like this?
Yeah, absolutely. Like within the option chain, we talked a little bit about Delta, which, as you said, a lot of people do use Delta. So if we want to look at that, Delta is way over on the left-hand side of the platform. So as we're kind of looking at this trade, if I were to come back to the strike, the first strike I chose was 197.5. So if we come all the way over on the left-hand side, we can see the Delta here, which is telling us what the likelihood of this particular option is expiring in the money. So if we wanted to see the opposite of that, instead, and we wanted to find out what the likelihood is that it's going to expire out of the money. So that's likelihood of in the money, likelihood of out of the money. We can come way up here on the right-hand side to our little hamburger menu, choose option chain, and then from there, we can actually select something like probability out of the money at, sorry, make sure we get that added there. So don't make the mistake that I just did. So we want to choose probability out of the money, and we want to drag it over here, click apply, and then we actually see the probability of out of the money as well. So for example, if we want to know the probability that our second option will, the one that we sold, whether that one will actually be actioned, then we can see here the probability that it will expire out of the money. So that's sort of giving us a bit of an idea here on this particular trade, how likely it is for, one to expire in the money and the other to expire out of the money, which is kind of ideally what we would want to see. So that gives you a little bit of insight there.
Awesome. Thank you so much, Caitlin, for walking us through the debit spreads and how to kind of check what our probability of success will be. Really appreciate you joining us. That's Caitlin Cormier. She's TD Direct Investing's Senior Client Education Instructor. You can check her out, as well as the rest of our team, in their workshops, their interactive workshops that we have going on during Options Education Month here through the rest of June. Also, if you're enjoying the show so far and you want to find out more about inside investing and all the stuff that we have going on at TD Direct Investing, follow us on social media, okay? We're on YouTube, we're on Instagram, we're on Facebook as well. You can check out all those things here, upcoming content that we have, other educational content designed to level up your investing game here. It's all there. Make sure you scan the QR codes on screen. You can check those out. We also have a really fun promotion going on right now on our social media page. Let's hear more about it.
The TD Direct Investing Starter Kit contest is officially live. Canadians can enter today for a chance to win one of 5 prizes, with a grand prize that includes an iPhone 16, a check for $100, 5 educational books on options trading, and a 1-hour private Q&A educational session with a TD Direct Investing Educational Manager. To enter, visit the TD Direct Investing Facebook page, follow TD Direct Investing, and like the TD Direct Investing contest post dated June 2nd, 2025. You can also gain a second entry by following TD Direct Investing on Instagram and liking the contest post dated June 2nd, 2025. There's a limit of 1 entry per social media platform. The contest runs until June 30th, 2025. Scan the QR code for full contest rules and details.
It's a great contest. Make sure you check it out here. All right, I believe we have David back with us now. We're going to get to our live Q&A now as we're running short a little bit on time here. Are you ready to hear what our audience wants to know more about?
Yeah, let's do it.
Okay, yeah, we got a lot of questions coming in here. Remember, if you want to get your question to David posed here, make sure you submit it to us. Again, on WebBroker, using that questions box. On the broadcast platform, we have the questions and comments box. And again, if you're watching on our YouTube live stream, if you follow the link in the description, that's going to take us to where you can actually ask your question there, and we'll get to as many as we can in the time remaining here. David, just out of curiosity, as we kick things off here, we got a question from Bally here. They want to know, do you think it would be possible to automate an options trade with predefined rules?
Yeah, definitely. I think maybe we're a few years away, or maybe a few months away. My gut feeling would be a few years away. I also think that by automating things, you're losing the engagement perspective. But yeah, you can definitely automate it with rules. Does it work exceptionally well? I haven't seen any evidence about that. But I think that for general rules, where you can use bots in order to give you ideas, and then you be the final arbiter. So combining AI with human intelligence, I think that would be probably best at this specific moment. But yeah, you can do it.
Okay, so the AI overlords haven't overtaken us in options trading just yet, is what I'm hearing from you here. But so it sounds like that's not something that you personally pursue much of?
No, I don't. I'm waiting for it to be. I'm actually waiting to see some of the studies that using AI trading is better. And I do think that, just like many things, whether it be chess or most other things, that AI will overtake our decision-making process. But I haven't really seen anything to indicate that it's that at this moment it's better.
Okay, good to know here. Let's get to a question from Ross here. Ross is asking us, do you use both weekly and monthly options?
Yeah, definitely. I use weekly and monthlies. Generally, for the especially when volatility is low, I like to shorten up my durations, because even if the VIX index were to spike, when you have shorter expirations, then it's easier to handle. If you're going to roll it out, you don't have to roll it out as far. Versus longer dated expirations are more sensitive to changes of volatility. So yeah, but I use both for sure. But I have a tendency to go more short dated for about like 1 to 2 weeks.
And why is that? Why the preference for the shorter dated?
Well, when using call debit spreads, I think the primary reason is I don't like to have longer dated naked put options outstanding for more than 45 days. Just because once you start increasing the duration and the expiration on those options, especially the naked put options, they have a tendency to be very sensitive to changes in volatility.
Right, so just hedging your risk there a little bit here. Let's get to a question here from Amrit. Amrit wants to know, how far down in expiry do you sell put options specifically? Also, what criteria do you use to purchase your options to take profit?
Okay, so how far down? Basically, I am looking at the recent trading range from like the past, anywhere from, generally it's about 3 months, but I give more credence and more weight to where it's been trading at over the past 2 weeks. And then I'll sell it at a level like that, at a level where it was basically trading at like close to its low, or 5 or 10% below that. So let's say, if Google, I think it's 50, or let's say even like its recent trading range, let's say for Meta, if Meta is trading at around 700, then if it were to trade down to, let's say, 650, then perhaps I would consider selling a strike price of about 620. So I don't necessarily look at delta. And then the other question had something to do about the call debit spreads, the expiry.
Yeah, I believe so.
Okay. Okay. So I think it was something about like when taking profits on the call debit spreads.
Yeah.
So
when did you know when to take profit? Yeah. Like, what do you?
Okay. So when I'm selling put options, I sell a strike price where I want to take ownership of the stock. And I think that's really important. It's actually one thing that we haven't really spoken about as much. Owning stock and combining long stock with options is probably, well, it's something that in my opinion would be the best strategy, because you're able to participate in the upside and take ownership of your, at the strike price of where you set your short puts. Now, with respect to the call debit spreads, generally, I will close out that position when it's trading at about 70% of the width of the call debit spreads. However, sometimes I'll leave it and let it expire. So, for example, if the stock jumps up over, if it's trading above the long call, or rather, if it's trading above the short call, then sometimes I'll leave it and let it expire. But in general, I have a tendency to close them out at about 70% the width of the potential profit. But like I said, if it jumps up above the short call, then sometimes I'll let them expire if I believe that it'll expire for a full profit.
Mm-hmm. Okay, good rules of thumb there. Yeah, I'm glad that we were able to get that in our conversation here as well. We have another question coming to us from Wilfred. Wilfred wants to know, what is the best lead time to expiry date for trading options?
Do you know what he means by lead time?
Lead time, yeah. I'm not entirely sure. I think maybe, could it be something around like how long do you consider the trading before you choose an expiration date, perhaps?
Yeah, maybe he's talking about like what are the best expirations to sell. Like I mentioned, I have a tendency to keep it more short term because I don't necessarily want to hold on to naked short puts for an extended period of time. But yeah, I wish I could answer his question better. I just don't understand what he means by lead time.
Mm-hmm. Do you find that you generally let options expire, or do you try to close them out relatively early if you think you can capture, most of the upside?
Yeah, that's a great question. I would say I probably close out around, maybe about 50% of them, maybe slightly less. But I do think that it's a good rule of thumb where if let's say you put on a trade, let's just use like a call debit spread, and then the underlying security jumps up in price. And let's say for the call debit spread, you have an expiration in 2 to 3 weeks. And then let's say within 1 week, you're able to capture over 50% of that premium, then I do think it's not the worst thing at all. And in fact, I would encourage it personally to simply close out that position, because if you have to wait 2/3 of the time in order to collect an additional 50% of the premium, then inherently the risk balance is different from when you actually entered that trade, because now you're holding, you're waiting 2/3 of the time, but at the same time, you're only able to capture 50% of the remaining potential premium. So yeah, if the security jumps up and it gives you a quick win, then definitely take it.
All right, that's something I've heard other options traders talk about too. So it's interesting to hear you say the same thing there. We got one more question here. This one's from Dutrone. For your 111 or 112 combo, how do you choose your strikes? Are you using technical analysis at all?
Not really technical analysis, although I guess you can say technical analysis, because I am looking at because I only have about 15 to 20 securities on my watch list, then I basically know like where they're trading at in their recent trading range. But yeah, like I'll look at the chart. I think I do have the some Bollinger Bands or things like that, or moving averages on my chart. Does it help me at all? I don't believe so, but I don't necessarily look at technical analysis, primarily because there have been a few studies out there that say that 97 to 99.8% of day traders end up losing money. And I would assume that a lot of them are using technical analysis. And I'm not a huge fan, but I am a fan of taking ownership or trading some of the largest companies in the world, which have very strong brands. And then in the worst case scenario, which isn't necessarily the worst case, you take ownership of the stock and then you ride it up and then participate in the capital appreciation, or simultaneously, you can trade options on it as well.
I know some folks absolutely swear by technical analysis. Some think it's absolute gobbledygook. But one thing I have heard from a lot of folks who do use it is that less is more. If you clutter your screen with too much, it just conflicting signals and stuff and makes it confusing. Sounds like you're of the same kind of mind here. All right, that's all the time that we have for questions here. David, really appreciate you taking the time to answer questions and to share your do's and don'ts with us. It was really fantastic having you on the show.
It was a pleasure.
And of course, for our audience, we appreciate you guys tuning in to check us out here. Make sure you watch next week's episode. Okay, we have another veteran options trader here, Marcus Heidecker. He's going to explain why he feels options trading is one of the best ways to escape the 9-to-5 grind, and his secrets to consistent income using the wheel strategy. So you don't want to miss this one. It's a really popular strategy. We're going to dive right in. That's all the time we have for now, though. So from everyone at Inside Investing, really appreciate you taking the time to watch, and we'll see you all next time.
Have more questions? Check out the links to the right and in the description below.